All right, folks, welcome to Investing for Beginners podcast. We are going to revisit Financials Demystified. We did gross margins earlier, about a month ago or so. You can check that in the archives. Today, we're going to go a little bit deeper on the income statement and talk about operating margins and maybe a little bit of OpEx or operating expenses and such. Andrew, let's talk about operating. I guess, what is operating margin? If I say that to people and they're like, what? What does that mean?
It's very helpful when you can start to visualize what an income statement looks like. Basically, what operating profit is trying to tell you is what does the operations of a business, what kind of profits are coming from that. There's a lot of different profit metrics that a business reports, which try to give you a picture of different parts of the business, because obviously at the very bottom is your bottom line. That's the profit, but there are a lot of pieces that go into that when you run a business. So for example, if we had a lemonade stand, you want to know how much does it cost you to make a lemonade, and then how much do you make when you sell it? That's gross profit. We talked about that last time. You also want to think about, well, how are you getting this to market? You not only have to make it, but you also have to spend money to advertise to get people in the door. So that's part of what we're going to be talking about today is operating margin. And then the last piece is just general things you have to pay for as a business, like the one we all hate, taxes. That stuff still happens, and that stuff changes. If you've followed politics and business history, tax rates change all the time. And so we don't want to be looking at just bottom line profit, because it's not apples to apples if tax rates are changing. That's why we want to look at operating margin. That's why we want to look at operating profit. So that's really the three big pieces. Obviously, we're focusing on that second one today, but it tells us a lot as an investor. How do you use operating margin when you're looking at stocks?
Oh, I use it a lot. This is, I kind of said this before we were recording, between the gross margins and the operating margins, that's really where the rubber meets the road for the business. Like, this is where all the really good stuff happens. And if you can understand these two parts of the income statement, then you can really get a really good handle on how this company operates, how they make money, how management manages the business, because these are the two main things that they have to manage. Is how much do these things cost them, and how can they make it profitably, and how can they come up with new products? So all those things are all kind of wrapped up in the gross margin and the operating margin. And I love to spend a lot of time looking at the operating margin as we're going to kind of deconstruct. It's a good way of really understanding what's going on with a business, like who does what, how they do what they do, and how efficiently and effectively do they do this. And it's a great way to separate the kings from the not kings in a particular industry or sector. So if you're trying to compare companies, looking at the operations, if they're making the same widget and one does it at a better operating margin than the other one, then you could probably conclude that they're just a better operation. They can charge more, they do it more effectively, they make more money, and the stock price will be rewarded over time. And so that's really what I try to use operating margins for, is to help me determine, okay, if I'm looking at this company versus this company, which one is better? And you can learn a lot from the operating income or the operating profit of the business. And I guess, so that's how I use it. I'm curious how you use it.
Well, I mean, it's the same way. It's very helpful to do it like that. So how do you calculate operating margin?
Operating margin is the gross profit, or the money that the company makes after their costs, and you take out the operating expenses, and that leaves you the operating income, and then you divide that by the revenue of the business. So just like gross margin, any gross profit you compare to revenue, and that gives you a margin number. You do the exact same thing with the operating income. You divide that by what's left over after all those costs and expenses are taken out, and you to compare that to the revenue, and that gives you a margin, which you can then therefore compare to other companies. So you can look at the operating income margin of a company like Google and Microsoft and compare them if you wanted to, or you could look at Uber and Lyft and compare them if you wanted to. So that's how I do it.
Yep. That is how to do it.
it's pretty easy. And the nice thing with Fiscal AI is it's now Fiscal AI. I will probably say FinChat, just a heads up, but they have changed their name. With Fiscal AI, they make it super easy for you to track all this with the companies. So maybe let's talk a little bit about the margins, what they can tell you about a business, and maybe some of the components that go into determining what the operating income or the operating profit of a company is.
Yeah. So there's different operating expenses, like you mentioned. The two big ones that you will see in fiscal.ai, R&D and SG&A. R&D, I think, self-explanatory, research and development. Tech companies rely on that a lot. That's where you get the big innovations. That's where the semiconductor companies make those great chip designs that lead to bountiful profits. SG&A is selling, general, and administration. You'll see sales and marketing costs in here usually. Things like hiring salespeople, paying commission to salespeople, paying for advertising, all sorts of advertising can all be bucketed in there. And so you have the gross margin telling you what have you made after you've created the product. Now, after you have researched to try to make better products, like I almost look at OpEx, operating expenses, like investments almost, where at the end of the day, if push came to shove, you could kind of shelve SG&A and R&D. Wouldn't be great for your business long term, but you could still technically shelve that and then make a profit from how much it costs. Because I mean, you can't get away from what does it cost you to make a product. That's always going to be there. So it's hard to dial that back, though companies can, but it's harder to dial that back. Something like SG&A or R&D is a little more discretionary. So I kind of think of that in the investments category. And it's how companies, especially nowadays, how a lot of companies reinvest for growth. Back in the old days, everything used to be tangible. Everybody would invest in warehouses and buildings and assembly lines. Tangible went through CapEx. We talked about CapEx previously. These days, the newer companies, the tech companies, are investing through the income statement, and looking at R&D and SG&A is a great way to try to decipher what's going on there and figure out how a business is performing and how they may perform in the future.
Yep, exactly. One thing to note, some companies, they may list general and administration as one item, and they may list marketing as a separate line item because they want to differentiate for investors how they kind of do that. It's the same idea, just sometimes you may see it broken out a little bit more in detail than other companies will just, like Andrew said, they'll just lump it all in together. And you have to kind of determine, okay, are they really spending that much on administration, or is it really all sales and marketing? And to Andrew's point, a lot of these companies that you look at nowadays, if you take a stroll through a cloud security type businesses, I'm thinking like CrowdStrike, Datadog, MongoDB, any of those kinds of businesses, you're going to see a lot of R&D and a lot of SG&A and not much CapEx. And so just because of the nature of how they operate and how they really invest in the business, to kind of double down on what Andrew was saying, that is very much, you'll see those numbers higher than you may see on the cash flow statement or even the balance sheet. And so don't think that they're not investing or they're not spending a lot of money to try to grow or build new products for customers. They most certainly are. It's just showing up in a different place. So that kind of leads me to, how would you, like when you're trying to analyze a business, how would you try to analyze how the R&D and how the SG&A really match up, and how you can kind of compare them across companies?
So I guess I'm going to have to let people get a little more under the hood like they did last time. So going back to my fiscal.ai custom metrics dashboard, a few custom metrics that I've added on here. Some of them are part of Fiscal AI already. Some of them I add myself. But what you can do is, especially for like a Datadog or a CrowdStrike, you can compare it to revenue, and then you compare what are the percentages and what are the percent differences. So for example, we mentioned the different ways you can invest: CapEx, R&D, and SG&A. you can put metrics for each of the three of those. So let's look at CrowdStrike for a second. These are last 12-month numbers. CapEx to revenue, 7%. R&D to revenue, 28%. SG&A to revenue, 50%. So huge amount of OpEx in the SG&A category for CrowdStrike. So they are growing a lot, but they are spending a lot to grow. R&D, they're also reinvesting a lot in R&D, trying to make their product that much better. And then, like to your point, Dave, about the CapEx being so small, 7% versus 50% for SG&A, 7% CapEx, that's hardly
Peanuts.
anything. So there are growth metrics, and I talked about it previously, but you can use CapEx to try to project future growth. But for a company like CrowdStrike, you would never want to do that because it's not the CapEx that's going to lead to their future growth. It's going to be more on the R&D and SG&A side.
Mm-hmm. Yeah, exactly. Could you pull up Nvidia? I'm curious. One of the things I want to kind of throw out there when people are looking at these numbers and comparing them, one thing you want to see for businesses that are doing really well is to see if that gap is widening. So as the company scales up their revenues, are the R&D, for example, is the R&D to revenue percentage, is that growing along with the revenue growing? And I suspect with Nvidia that they're actually creating a gap. And that's one of the ways you can see if a company has operating leverage, which is basically, can they grow faster than their expenses grow? And that can lead to a lot of profitability or free cash flow, which the company can use to reinvest, and thus the flywheel. So I'm just curious, when you pull up Nvidia, if that is what we see or not.
Mm-hmm. In the case of Nvidia, you do see that operating leverage from 2016 to last 12 months. R&D to revenue from 27% to 10%. SG&A 12 to 2. So as to your point, Dave, as these numbers have gotten smaller, that means Nvidia has just gotten more and more profitable. And it's interesting to see for me, okay, is Nvidia a sales company or are they an R&D company? And that kind of sounds silly, right, saying out loud, but the numbers do check out that, yes, in fact, they're spending right now almost 5 times more on R&D than they are sales, SG&A, sales, general, and administration. So that's a good way to check. And this is very helpful to me, not just to confirm narratives, but to help you when you're looking for the first time at a business. What are the things that are most important to track for a business? And that can help you learn so much about a business. You could Google endlessly. You can chat GPT endlessly about different random facts about the business. But until you put, pen to the paper, numbers to the narrative, you won't really know what's really driving the business until you check on some of those things. And so going back to the whole CapEx idea, which if you know Nvidia, they're fabulous, it's all obvious, but the numbers check out. CapEx is only 2.76, SG&A 2.5, and then R&D is 9.5 compared to revenue. So again, R&D is driving that growth. And even though they're not having to spend as much R&D as they were before, which is making them more profitable, they are still continuing to push that investment lever, which makes you hope as a shareholder that they will continue to have the best, most dominant product to help them continue to grow like they have.
Mm-hmm. Yeah, that's awesome. So, would you say that these kinds of businesses, I'm not just saying Nvidia in general, but these kinds of businesses are maybe the ones that we really should try to seek out? Are these companies that can start to exhibit some of those operating leverages, perhaps?
You don't want to ask me that.
Okay.
I'm a little more of a pessimistic kind of guy. I'm more Mr. No than Mr. Yes. And you could spend, so the counter argument is you can spend a lot on R&D, but that doesn't guarantee anything. So the way I kind of look at it is like, not that R&D is good or SG&A is bad, more so like, what is the company's strategy? So in the case of Nvidia, I wouldn't care about analyzing their sales team or something if I was trying to figure out, do I think they still have the moat? I would really focus, and everybody does obviously, but really focus on the tech and what are they spending the R&D on and how is their tech evolving. And so for companies you're not familiar with, that can be a very helpful step.
Yeah, yeah, for sure. That's a very good point. One of the things that also can make looking at the R&D of a business challenging is that typically when they are spending money on R&D, they may or may not necessarily reap the results of that spending for many years. It could take a while. So when you think about a company like Nvidia or Microsoft, any of these businesses are investing in these products. They don't build something like a Blackwell overnight, and it doesn't happen in 7 months. It takes many years and a lot of work to get to the point where they can sell something like that that is a hit on the market. And so when you're talking about investing, when a company's trying to invest and you look at Nvidia or any of these other companies that we talked about, the thing I always like to think about is how does that really translate to the investments? And it goes to something Michael Mauboussin has talked a little bit about. I'm not going to go super in depth on this because this could really derail everything. But he talks a lot about, in some of his papers, talks about kind of deconstructing how companies actually invest. And because companies like Nvidia, Microsoft, and others spend so much on R&D, those investments aren't realized immediately. And so it's kind of unfair to those companies to look at their earnings, for example, and they're actually probably a little bit, I guess, more pessimistic than they really should be because they're expensing that money of R&D. It's coming out of the income statement immediately, whereas balance sheet investments may take a little bit longer to be realized on the income statement. And so what Michael Mauboussin talked about was basically kind of, in essence, taking money from the income statement and adding it to the balance sheet and then kind of rearranging how the accounting actually works. And it sounds like a lot of gobbledygook, and I will put a link in the show notes to his paper that he discusses this, because he really kind of deconstructs the cash flow statement and the income statement and shows how we should try to look at these investments and how it can help you kind of adjust how you think about the companies. So maybe not necessarily the numbers per se is important. It's more about thinking about how Nvidia really invests is a little different than other businesses, and so you have to think about it differently. And his paper can help you kind of deconstruct that a little bit.
Yeah. One of the things, and I'm glad you brought that up, and we're going to go a little bit down the rabbit hole. So just buckle up if you aren't already. And there's nothing you could do at this point. So here we go.
Yeah.
One of the things that these great tech companies have, which I love it, by the way. I mean, I have some great tech in my portfolio, so I'm not bashing on tech whatsoever. But one of these things that is so special about some of these businesses is they have crazy high return on invested capital, or ROIC, which means that based on that metric, you're trying to see how capital efficient are they. So Apple is an extreme example. I've used it before. If you're netting for cash, they have ROIC above 100%. Booking holdings actually have negative invested capital based on the way the accounting is. So their ROIC is infinite, right? Warren Buffett used to talk about return on equity, which is very similar to return on invested capital. And you can take return on equity to try to project what future growth will be. In theory, you have to adjust for retention, dividends, buybacks, these things. The problem with the fact that ROIC is not adjusted like Mauboussin is saying it should be is that the high ROIC is an illusion. It is making, because it's expense, it's making the invested capital look so low. So when you see Airbnb or a Booking or, one of these huge ROIC companies, that's not actually the type of growth that will happen. A lot of it can be just because of the fact that they have invested through other means in order to get that growth. It's just one of those weird things. I think you said it best a while ago on the show, and you used to say it a lot. No matter how great a company is, they always have to invest capital to grow. And so just because the accounting makes an ROIC look too good to be true doesn't mean that this is just a company that's going to continue to grow at 20% for the rest of the universe's life or anything like that. So I think taking Mobison's ideas and thinking about the way that companies invest and how we can try to account for those things is helpful. And I think doing that can really help like tamper down expectations on what to expect for a stock. So I'm going to use Booking Holdings again because, like I said, it's one of those examples where you pull up the ROIC, you make some adjustments, and even after doing that, you're like, wow, ROIC 300%, this must be the best business that's ever been around.
Ever.
Or ROIC infinite because invested capital is negative. With metrics, you always want to have checks and balances. You always want to have other metrics that provide context. In the case of Booking, what you would want to add is not just looking at ROIC, but you would also want to look at how much are they doing in buybacks, how much are they doing in dividends. And so when you take that into account, which is something I think Damodaran mentioned, when you project growth using ROIC and retention, you want to look at how much money is given back in dividends and buybacks. And so when you do that, again, I can look at the custom metric. If that number is negative, meaning there's more money being bought back than actually earned in the business, then you can't really use ROIC to project what future growth will be. And I promise you this ties into our whole conversation today. So again, if the company's just buying back with all the profits, it doesn't make it a bad business or a bad investment. I think See's Candy was the perfect example of a company like that for Buffett, where he said, look, See's Candies is only in California, I think at the time, and is not trying to expand all the way across the United States. See's Candies is raising its prices year after year after year. And rather than taking that money and reinvesting it, trying to get into Texas and New York and Canada and Mexico, they're just taking that cash and giving it back to the owners. And so when you look at a Booking, I have them pulled up here, CapEx to revenue, tiny, like less than 2%. R&D the revenue, 0. SG&A the revenue, yeah, it's a lot, 50%, but that number is kind of flat over, if you click on the chart, it's mostly flat, a little bit up and down, but mostly flat. And then M&A, which is mergers and acquisitions, another way companies choose to grow, is very, very small percent as well. And they haven't done anything in the last 2-3 years. So you look at all those things and you're like, okay, there's no obvious reinvestment lever. So what are they going to do how are they going to reinvest in themselves? And sometimes the answer is they're not. And so if you're looking at, again, to prove the point, if you're looking at ROIC and you think this is the best, most capital efficient business that I've ever seen, but there's nowhere to put that capital and they're just buying back shares, then you just have to kind of temper your expectations on where you think the stock's going to go, how you think the business is going to go. And like I said, that could be a great investment, but we want to try to analyze a business in that, like, where are the reinvestment opportunities rather than just saying, well, they've grown. Okay, I could pull it up. They've grown 5-year revenue at 10% a year over the last 5 years. So they're going to continue to do that because that's what they've done and their ROIC is really high. I'm trying to avoid that kind of thinking because then you can avoid disappointment when things actually don't work out that way. Am I making sense here? Because I've gone on.
Yeah. No. That totally makes sense. And that kind of goes to what Buffett has talked about when he refers to high returns on capital or returns on equity. Is his ideal companies are companies that generate those high returns on capital, but also alongside that have opportunities to reinvest that money so they can continue to grow. And what you're talking about with Booking Holdings reminds me a little bit of a company like AutoZone, O'Reilly, some of those auto companies that are spending, a lot of money on dividends and particularly buybacks. And I suspect are not spending much, if any, on investment opportunities. And so it very much reminds me of that model. Now, I'm not saying it's a bad investment or that it wouldn't be a great investment. It's just something to realize and keep in mind that maybe it's not necessarily air quote a tech company, that it maybe is at a different stage in its life cycle and management just can't find anywhere else to put the money. And so instead of it sitting on the balance sheet, they're going to do those other things. And in and of itself, that's not horrible. But if you have the expectation that it's going to be, a Google or an Nvidia type investment because of their ROIC and their high margins, you might be disappointed. I'm not saying you will, but it's something to certainly keep in mind. And the way you framed it, I think, is a really good way to think about it, because it's going in. To me, it's going an extra step. You're not just looking at the margins. You're not just looking at the ROIC. You're not just looking at the operating margins and the income and all the different ratios in there. You're going an extra step. Like, what are they doing with it? Where's the money going? And that's just as important.
Yeah. I wish that more people, or the discourse would be, when you talk about growth, stop talking about how much, talk about how.
Mm.
How is the growth going to happen? I don't care. Don't put a random number like, 10% last 5 years, 10% next 5. How?
Right. Yeah. And would you say that these using a combination of these custom metrics that you're talking about, the things that Fiscal AI already provides normally, can help you start to come to those conclusions? Like, how? Where is it going to come from? Because it has to, like I said a lot, every company has to reinvest to grow. And if they don't, if they do, you got to figure out how. How are they doing it? Where's it going? And if they're not, then you also have to understand where is the money going that they are earning. Because if it's not showing up on the balance sheet, it's got to go somewhere.
Yes. Yep. And AutoZone, I think another good example of that. CapEx to revenue is pretty small, 6.5. SG&A the revenue is high, 33, but flat. And so when you look at their KPIs, you look at total store square footage. I love using retail because it's so much easier to understand sometimes. Square footage, which you can think of just like number of stores, or are they expanding those stores to sell more items, only up 3.5% a year. And then they have like an organic growth number. So average net sales per AutoZone store. Again, if you're on Fiscal, you can go to their segments data and follow along. But that's also small, like 3.2. So you got 3, you got 3.5. That gives you 6.5% growth. It makes sense. Those are the general growth levers. And outside of that, is there really anything else? Doesn't seem to be, based on looking at the numbers. And so, okay, they are just going to do a lot of buybacks. And that's certainly what they've done since at least 2017.
Could we just, for comparison's sake, maybe take a stroll through a company that's maybe a little bit more of a hybrid, and maybe look at something like Microsoft or Google and see what those ratios are for those companies, comparing what we just looked at with AutoZone and Booking?
Yeah, great idea. So Microsoft, I'm just going to go down. We're looking at CapEx, R&D, SG&A. What percent to revenue? CapEx 22, R&D 11, SG&A 12. So to the point where we talked about with Microsoft really investing heavily in the cloud, buying a bunch of servers, building server farms, they've actually changed their model. So if you chart it all out, it used to all be around the same CapEx, R&D, SG&A. CapEx has shot up, and you can directly correlate that to their investments in Azure, which is their cloud segment. And so it's interesting to see, they still invest in kind of getting more customers. I'm sure there's salespeople on the enterprise side and things like that. They're still investing in R&D. They're still trying to make Microsoft Office better, that whole suite of products. And then they're obviously aggressively going in the CapEx. Let's pull up Google just because I'm curious.
Yeah.
You mentioned them. CapEx 16, R&D 13, SG&A 11. Similar story where you see kind of like this spiking in CapEx, but they're not doing as much as Microsoft. They're also pretty heavy in their R&D and their SG&A. But interesting to see both of those have SG&A and R&D very similar to each other. So they are They're doing all the marketing things, but they're also reinvesting in themselves, reinvesting in the product. I imagine a lot of that money goes to making Google's algorithm better, going towards AI, Gemini, things like that. As a shareholder, you would hope that those things are getting better so they can continue to do what they do.
Yeah, exactly.
Now we kind of understand that whole picture and everything. I thought it'd be a little bit fun to pull up a few companies that are newer-ish and see if we can apply everything we've just taught and try to make sense of some of the companies. So I asked Copilot over here on Fiscal, like, give me a list of tech IPOs since 2020. So if any of these pique your interest, let me know and I'll throw it in here. We'll see, what this breakout is. So Airbnb, DoorDash, Upstart, Palantir, Snowflake, Lemonade, Roblox, Coinbase.
Palantir.
This has been a good bet for you.
Yeah, right.
CapEx very small, less than 1%. R&D 17%. SG&A close to 50%.
Okay.
And something I also threw in there. Not what you expect?
No, about what I would expect.
Yeah. Well, it's interesting to me when I think of a Palantir, like I don't know the business at all, but I know they're in kind of like the defense tech is kind of how I think of it. I would have thought that the numbers would have been flipped a bunch in R&D and not as much as SG&A. So
yeah.
Is it? It's a hype train. I don't know.
Yeah,
I won't
probably
say.
a little of all the above, for sure.
Any other ones on here?
Yeah, let's take a look at Airbnb.
Okay, we can do that. So Airbnb capex, no capex. R&D 19, SG&A 39. Okay. And so for both Airbnb and for Palantir, that SG&A number has started high and then started to come down as the company has matured. But yeah, still doing a lot more in SG&A than R&D.
Interesting. Okay.
Yeah. Let's talk about that for a second. So
the
Airbnb thing, where is the SG&A going? Because like, at least here in the United States, I feel like everybody kind of knows what Airbnb is. Maybe they're just, maybe if it's always top of mind, you're always pulling the app up versus going direct to a hotel. Is that kind of the idea? I mean, I know their ads on TV have been pretty compelling in a way. They kind of rip on the hotels.
Yeah. I would say that would be what would come to mind when I think about Airbnb.
Okay, let's take one more, like Coca-Cola. Because I'm curious, like what they do with very established brand, kind of everybody knows them, but you still want to spend on SG&A to keep top of mind, right? I would imagine. SG&A been pretty flat since 2019, at around 30%. Used to be higher in the 2010s, around 36, 37. If we were to compare that to Pepsi's actually been like super, super flat. 37.9 to 38.5 in the last 10 years. Basically, Coke reduced their SG&A. Pepsi's kept it flat. Have they had similar growth rates, or did Coca-Cola reducing their spending make them fall behind from revenues? And if we use a slider to go back to like 2012, 2013, I mean, Coke has been flat. Pepsi's been 2% a year, almost 3% a year. So that's interesting.
Yeah.
Did Coke shoot themselves in the foot by trying to get that operating leverage in SG&A when maybe if they kept that same marketing spending, maybe they would have kept up with Pepsi?
Yeah. Yeah, for sure. Yeah. I mean, and those are the interesting questions to ask when you're trying to dig deeper into the income statement or just the general mood or the vibe. Since vibe is a big word now, just to look at the companies and try to determine what's really driving, you said that earlier, what's driving the growth, where is it coming from and why? And if you're comparing, which would you rather invest in then? Would you rather invest in a company that's air quote taking its foot off the pedal, like Coke apparently appears to be, or would you rather a company that's at least pressing on the gas, like Pepsi is, to at least grow a little bit? I mean, 2 to 3% is not earth-shattering numbers, but it's better than its comparison. So, I guess that's the question: which would you rather do?
Yeah, that's a great way to look at it. I would say that kind of thinking doesn't come naturally, and that's why it's important to try to dig into the numbers and try to ask yourself those questions. Hopefully, people heard on the air we were kind of just curious, asking questions, and then you can use fiscal to check, and answer those questions quite quickly, and that helps a lot in forming narratives that are more accurate and that tell you more as an investor.
Yeah, yeah, for sure. Totally agree. All right. Well, with that, we will go ahead and wrap up our conversation, demystifying the operating income for our business and the operating margins. I hope you enjoyed our conversation. If you are interested in learning more about Fiscal AI, check out our links in the show notes. It's a great platform. Andrew and I use it every day. We have become bigger and bigger fans of Fiscal AI. It's a tool that you can use to really help you become a better analyst and find better opportunities. So with that, we'll go ahead and sign us off. You guys go out there and invest with a margin of safety. Emphasis on the safety. Have a great week, and we'll talk to you all next week.